26-year career on Wall Street. Started out as a runner in Chicago, which you can tell from my accent. Worked my way through the commodity futures industry.
I'm sorry, I'm just having
Okay. Worked my way through the commodity futures industry. And was a director of, or ran, the world's largest purveyor of commodity hedge funds and the world's largest distributor of commodity futures and options products. I'm here because I want to be here. I came out of retirement, stopped joining now about 2 or 3 weeks ago. Over the course of the next few months, I expect to meet with many of you talking about different ways in which we can access commodity markets and in so doing improve and enhance our portfolio of investments.
All right, thank you.
Welcome aboard.
Thank you. Before we get to the regular business, I just want to mention that prior to this meeting, we had an attorney-client session. The board voted on a legal settlement matter, the results of which will be announced at some future date. Okay, now we can start with, I guess, performance reviews.
Okay, again, the year-end review, and Mark will walk us through that.
All right, I have some copies here. And I'll pull retire questions on that.
No, they're doing this one first. That's the
So the June quarter was roughly flat. It was up about 1%. For the year, however, the big story is the very strong level of absolute returns that we saw, and we'll see that in a moment. This was mostly helped by Fed policies and the quantitative easing program. U.S. equities were up over 32% for the fiscal year. Non-U.S. equities were up about 30%. And even fixed income got in on the action, although not quite strong. High yield was up over 14%. Convertible bonds, because we expect upside when equities do well, also were up strongly. So for the fiscal year to date, if you turn to page 9, you'll see the quarter was 104, 3 basis points behind the benchmark, but the real story is the year ending June of 2315, which when we look back was one of the highest returns that we saw for a fiscal year going back several decades. The good news also is that these returns lift up the longer-term results, which include the downturn in 2008.
I'm sorry, lift up all returns.
The longer-term results, which back in 2008 and early 2009, which saw a significant market decline, so the 3-year and 5-year numbers are now near or above 5%. Next page on page 10 shows the asset allocation, or the pie chart that shows where the assets are invested. The bottom shows where the assets are relative to the policies. Of course, the Fire Board back in June adopted a new asset allocation. So in just a moment, when we go through July, we're going to show you where you stand versus the old as well as the new. This is showing you versus the old policy. And versus that policy, we were slightly underweight U.S. and developed markets and overweight emerging markets. And of course, we have the underweight to real estate. The next few pages go through attributions and returns, but I do want to draw your attention to page 15, which shows how FIRE did versus other large public funds. And if you look at the page in the middle towards the right, it'll show how FIRE did versus large public funds defined as funds larger than $1 billion. And the number in parentheses next to the 2315 tells you your ranking. And the ranking was in the top quartile. So congratulations, that was
2315?
2315 ranked in the top quartile, and that's the blue dot in the blue bar. This is now the second consecutive fiscal year that FIRE was in the top quartile, so that's also very good news. The next page shows how the effects of these...
Congratulations to all the trustees.
Yes, congratulations. This was obviously very strong returns and helped the funding and brought, in fact, the market value up to a new high of $8 billion. The next page shows the annualized numbers, and because of the last 2 years, we were at $8 billion in May. I believe we ended just shy of $8 billion for June. It was 7.9 and change. It does round up. It does in fact round up to 8, but it was on an actual basis. It was just shy of 8 million.
Great.
So on page 16, you see how those last two top quartile results help bring the longer-term numbers in or around the median returns. Seema's here, and she's going to go through, starting on page 17, some highlights of the equity portfolio.
Thanks. So if you turn to page 19, you'll see the domestic equity return versus the Russell 3000. And if you just look at the quarter, it's trailing a little bit behind the benchmark. But importantly, if you look at the fiscal year-to-date numbers, you can see that the index itself was up over 30%, so 32% plus. And we did more than 200 basis points better.
I'm sorry, and you did.
And we did better than that with the large cap name, was actually outperformed by over 200 basis points. So that actually helped us a great deal. You might remember that we did some changes in the large cap U.S. portfolio last year, which I think helped contribute to that performance. So if you turn to the next page, 20, this just shows you how your domestic equity allocation is split among small cap, mid cap, and large cap. And just a couple highlights for the quarter. If you look at the few columns in the middle, the index return, the actual return, and then the difference column, just a couple highlights there. In small cap active, we outperformed quite well, and Brown and development factors continue to do that. On the slight negative side of the small mid cap and mid cap, we were slightly there behind the benchmark, but that we've got some newer managers there, one of which is Times Square, and so those are just kind of early numbers, and we'll just keep an eye on that going forward. Now, if you just turn to page 26, which is supposed to be the national portfolio. And there you can see how it's split out across emerging markets, and then your equity managers, and then you've got passive allocation as well. And I just point out the bluish teal piece of the pie, the 27% or so, which is emerging market equities. And you might also remember we've been growing that as part of the passive allocation, so that number has gotten bigger and will continue to get a little bigger as we move forward. If you turn to the next page, you can see the EFO returns. And I'll just point out for the quarter that purplish bar is our total performance, and the yellow bar is the EFA index. So we're outperforming by about 30 basis points there for the quarter. But importantly, if you look to the next set of bars, fiscal year to date, the numbers are big, up over 30% in general, but we've actually done better than that, about 100 basis points or so better than that in our portfolio. Turn to the next slide, 28. This goes through the emerging market returns. And again, for the quarter, we're slightly behind the benchmark, but if you look to the right, the far bar there is 28% for the index, and slightly behind the index for the fiscal year. Strong numbers at up 27%, but you might also remember we're doing an emerging market search right now, where we set out to help find some additional strong performing managers, and so we hope to come to you soon with some results of that. I'll get that up portfolio.
So you're given the increasing rate of international equity, but you have page 20, the attribution of the domestic equity. Get started meeting the attribution of the international.
And now I'll pass it over to Mark.
So we have one last item on the equity front, and that's on page 29, your REIT portfolio, which is about 4%, or $325 million as of June. The returns were very strong on an absolute and relative basis, although for the quarter it was behind by 18 basis points. The results were strong at 384, bringing the year's results at over 35% ahead of the benchmark. And the returns for the longer period since inception are also ahead of the benchmark. If you look at the 8-year numbers since inception, 1237 ranks as one of the highest returns we've had in any asset class over this period. There have been fundamental and technical factors that have helped REIT returns. Interest rates declined. There were companies that were able to refinance. Private real estate companies are very difficult to access for a lot of investors immediately, so they use ETFs and go into REITs as a substitute partially for real estate, and also just strong technical demand from investors for the sector. The sector is roughly about 100 stocks, so and the yield is also attractive to many investors. So all those factors help performance over the past several years. Turning to fixed income on page 32 is a summary of where the assets are located. It was a little over 30% for the fund, $2.5 billion. The largest allocation is shown in red, and that is the investment grade 4 plus 5 or structured program, which is further broken down on the next page. You'll note the over-underweight column, you were underweight treasuries and agencies, the government sector, and overweight the spread sectors. If you look at the actual return or index return column, you'll see all three were positive numbers, which was good. Government sectors did best, so the underweight hurt on a 4 basis points. The managers themselves underperformed slightly, as you see in the difference column. Taking it all together on the next page, the program for the quarter had positive results of 238, slightly behind the benchmark by 19 basis points. But for the year, was ahead by nearly 100 basis points, returning 514. And importantly, we now have record going back 15 years and even beyond the 4 plus 5, which is turning roughly in the 6.5 to over 7% range with 45% volatility. TIPS is on page 35. The results were strong on an absolute basis. Managers were behind on a relative basis, and that's mostly due to some exposure to nominal treasuries versus TIPS, which are allowed, and real rates declined more than the nominal rates, and so that difference explains partially the underperformance, although the underperformance is a bit modest. The volatility was in the 7% range.
So do you guys foresee any tactical rules here like they did on high yield, given tips all the way to 15 years are negative real yield?
Well, just a week ago it was down to 12 years, it's negative real yield. So that's part of the technicals in this area, and we have, in fact, been working on that to say, just like we've been doing with high yield, to sell high and to tactically go back in when yields make a little more sense.
I'm sorry, and
To tactically sell high and go back in when yields make a little bit more sense.
We sold $1 billion last week.
I have a total of what you think.
I'm sorry, I can't hear you.
That's it. I think we got just the high tip.
It wasn't,
Across all the systems.
Across all the
Across all the
systems.
systems, $1 billion.
So that represents about 20% of the work.
It was probably 60 basis points on the total figure. How much we fired?
Okay, but you're thinking you
Program.
It was pro-rata across the government and the tip centers, yes. High yield, does that answer the question?
yeah.
So page 36 shows enhanced yield or high yield, and the results here, we've seen very strong numbers. The quarter ending June was a 1% quarter, slightly ahead of the benchmark. For the year, another strong year after the strong year in the prior fiscal year. This year was 1504, 44 basis points ahead. But I really want to draw your attention to the 3-year number and the blue bar. The high yield program has returned over 270 basis points ahead of the benchmark, over 10%, nearly 11%. And in fact, this includes the 2008 downturn where high yield suffered along with other risky asset classes. So looking at these numbers, the high yield market as of June had effectively fully recovered on a performance basis from the downturn in 08. We do not see it in the numbers here. And that is partially why we were reducing selling into strength. Convertible bonds on the next page, they track equities. Our rough formula that we use should be about 70%.
I'm sorry,
Our rough formula that we use should be about 70% of the upside with about 40% of the downside. This quarter was slightly negative, and for the year, strongly positive. I do want to point out two things. On a 3-year number, we now have a 3-year number. So we've been seeing the 1- and 2-year numbers and questions have come up about the underperformance. So I had mentioned that we had funded the accounts mid-2008, and in that down market, the managers outperformed. The 3-year number now shows that. We also added a purple bar, which we labeled custom index, because each of the managers have their own benchmark, as we discussed, and they're beating their own benchmarks, yet we're showing they're underperforming the overall index, because the overall index is a different benchmark from each of the managers. So we want to give you another piece of information. And so the purple bar really is the blue bar compared to each of the individual managers' benchmarks weighted for their investments.
Martin, how do convertibles do when you have this backdoor situation where the bond yields are lower than dividend yields? How do we perform?
There is convertible bond universe is very small, so some investors simply ignore it. And so investors that do participate are able to take advantage of areas when there are dislocations in the market just because of.
I'm sorry, when?
There are dislocations in the market as far as the relative yields go. It's similar to REITs, where REITs typically historically will trade at a premium to treasuries, but sometimes as on 10-year treasury, typically about 100 basis points. But there are times when it's cheaper and times when it's more expensive, so managers definitely take advantage of it. I will tell you that the managers that we have in the portfolio per FIRE are a mix of a bond-sensitive manager that has a lower delta and a much more equity-sensitive manager, so we do have a little bit of both in this portfolio. The short answer is they're active management in this market, in a flat and down market. We'll see that next quarter when this market rallies next week. We will see what we hope to see would be flip-flopping of performance when we would expect that they would be outperforming because of how they manage.
I'm sorry.
That we would expect that they would be outperforming because of how they manage versus the index, which is led by a few large issuers. Opportunistic fixed income is on page 38, and we have the new benchmark shown here in yellow. That's the 10% return. And we also have the secondary benchmark, which is a high yield benchmark plus a premium. The managers outperform, and results are quite strong on an absolute basis. And we'll be talking more during the meeting in the executive session about this. Holly is here to talk about ETIs.
So on page 39, we have the ETI index. The ETI portfolio is shown net of fees. And while it trailed the custom benchmark for 3 months and 10 years, it outperformed for all other periods. The collateral benefit report starts on page 8 in your agenda package. And I would like to make one highlight on page 9. Page 9, we're looking at the HIT. The HIT provided $134 million in financing for the Penn South Limited Equity Cooperative, which was built by the Ladies Garment Workers Union in the early 1960s. The complex needed some rehabilitation. The financing was contingent on the cost remaining affordable for families for at least 20 years going forward. So that's my one highlight. And are there any questions about the collateral benefits report? Thank you.
I'd like to continue the discussion about performance over the fiscal year within the real estate portfolio. So first I'm going to talk about the fiscal year kind of in general in terms of the real estate markets and the FIRE portfolio, and then just give you a snapshot of where we are for first quarter 2011. In terms of the past 12 months during the fiscal year, there was some encouraging signs in terms of real estate, a muted recovery after the bottom in 2009. And we saw that in several ways. First, in terms of transaction volume, during the fiscal year, there was about $170 billion of real estate transactions taking place in the market, which is significantly higher than the $71 billion that took place in 2010. Also, in terms of those transactions, in the environment of lower interest rates and also the better availability of credit, we were able to see more transactions, particularly in New York, DC, San Francisco, some of the gateway markets. In terms of who's lending, the traditional lenders came back, the commercial banks were there, the insurance companies were there, albeit with some more stringent underwriting, and certainly not to the degree, not at 75% loan to value, more in the 50 to 60 loan to value range. We also saw during the fiscal year some CMBS activity. However, I would say right now that is kind of muted at this particular point. At the height, the CMBS market was able to finance about $225 billion worth of deals in 2007. That activity is projected to be about $50 billion in 2011, but we don't think that it's going to reach there. There are still some problems revolving around ratings and such. So whatever can't be financed through the banks or the insurance companies, or perhaps with some of your very own non-core manager with gap financing, that's how deals are going to be getting done. We talked about transactions happening in the gateway cities. These are primarily for core properties that have very strong current income. You have about 11 core managers, and they're actively pursuing deals in this space. Another place where you can obtain attractive yields is if you have the skill set to be able to reposition or redevelop properties, in which you have about 23 non-core managers who are actively doing that as well. Property fundamentals. There's absorption taking place over the past 12 months in each of the property sectors: apartments, office, retail, industrial. I would say the star there is apartments. There's definitely more transactions happening in apartments, rental growth happening in apartments. Why? The pool of renters is certainly growing. Unfortunately, folks are losing their houses. Also, folks are delaying their decision to buy homes, and therefore the pool of renters are certainly increasing. Just kind of reflecting back, particularly on the fire portfolio itself, the one-year return was 22.6% for the fiscal year, which was about 360 basis points above the benchmark. The benchmark is the Odyssey benchmark on a net basis, and we outperformed that benchmark for the fiscal year by 360 basis points. The quarterly performance for first quarter 2011 was 3% compared to the Odyssey at 3.8%. So we're kind of trailing it, but kind of up and down. But for the past 12 months, certainly we had a very strong performance versus the industry benchmark. In terms of who was driving that return, it was primarily Blackstone, CIF, and PRISA funds. And I would note that all three of those funds are part of your largest exposures. So when they do well, we do well. And hopefully we'll continue into the foreseeable future. We also did 4 deals for $65 million. We did 2 re-ups, and we did 2 non-core managers. And so we also plan to be bringing you additional transitions and recommendations in the months to come. Thanks. Are there any questions about the real estate portfolio?
Okay, I'm going to spend the next few minutes talking a little bit about private equity, touch briefly on the market, and then with that, really got to go right into the performance of the portfolio. So if we look at the marketplace today, there's been a significant increase in deal size. Oh, I'm sorry. We are on page 20. We start at page 25 in the book. There has been a significant increase in deal size in the overall marketplace today. 50% of the capital invested in deals today are in deals greater than $1 billion. The most interesting statistic is the amount of dry powder, so the amount of money that's really sitting on the sidelines. And just to put it in perspective, at the end of 2010, $410 billion of dry powder. As of June 30th, $390 billion. So there's been an increase in deal activity, putting more money at work. In the market today, there are 1,650 plus funds being raised. It's the highest number ever recorded. They're looking to raise in excess of $660 billion. The good news is not all those funds will be raised. And if you look at it to have a healthy market environment, not everybody can raise capital when it comes to the market. If we look at just some numbers, throw out some statistics, global fundraising for 2010 was approximately $110 billion, down from 168. And the peak number, just to put it in perspective, 2007, $560 billion. If we look at the pacing for 2011, it looks like the number should be 30 to 40% greater than 2010. Throw out a couple of deal numbers just to give a little perspective, and then I'll go right to the performance of the FIRE portfolio. If we look at large PE-backed IPOs, HCA raised $3.8 billion. Kinder Morgan, $2.9 billion. Again, these are both IPOs. While there's been significant volatility recently, this has put a little bit of a hindrance on exiting the market through the IPOs. But again, when the market was very robust, there was some pretty strong exits. One I would mention is Nycomed, which is actually in the FIRE portfolio through Avista. It's a pharma company sold to Takeda Pharmaceuticals, Japanese pharma company, for a little over $13.5 billion. So that's just a little perspective on the overall market. If we touch on the FIRE,
Barry,
yes.
This huge potential digital or
Dry powder.
yeah, any patterns? Europe, U.S., large, small.
So if you look at the market today, it's clearly focused on the larger transactions. If you look at Europe, Europe lags the U.S. historically. That's just been the way it's worked. If you look at the marketplace today, there are some big funds coming to the market. They're going to generate an enormous amount of dry powder. And some of the funds that are in the market, you can name 2 or 3 funds that will represent $25 or $30 billion. So even though people say the market has slowed down, the big managers are still raising large funds. The expectation is over the next few years, again, this is tied very much to the high yield market, what happens in the financing market. But that being said, the anticipation is that there will be larger deals, lots of deal flow activity. And when I touch a little bit later in the presentation, it's reflected actually in the distribution numbers for the overall FIRE portfolio. So it should be a good time to invest in private equity over the next few years.
Larry, if I could.
Sure.
All the dry powder, so you say, is that's increasing. Where are these assets coming from?
So what's happening, there's a combination of things going on in the marketplace. So there are what are called secondary buyouts. And what these are is when one private equity fund sells a company to another private equity fund. In many cases, what that means is that a company has reached a certain level of scale. And a private equity managers, if we think about the overall private equity portfolio, managers are good with companies of a certain size. Once they grow larger, they need to get some realizations and they sell it to a larger manager. So that's one possibility. The second would be corporate carve-outs. So if you look at the marketplace today, big corporations, they're looking to exit certain businesses that they believe to be non-core, non-strategic. So that's another opportunity. The third opportunity is distress. Enormous amounts of de-stress in the market, and the definition of distress kind of varies across the board. So that's an opportunity. And the last one I would mention is energy. Energy is very, very capital intensive, and there's enormous amounts of dollars being put into the energy space today, and that will, hopefully in the future, continue to grow. So those kind of 4, what we'll call verticals, is where a lot of the money is being targeted. If we talk a little bit about performance and where the FIRE portfolio is, just to reference the 2011 strategic plan, allocation, where we were between 5 and 7%. There was a change in the strategic allocation based on the strategic allocation of the overall FIRE portfolio. We're at 6%, so we're right in the middle, so we're in a good spot there. If we look at the overall returns for the portfolio, continue to move in the right direction. The returns right now, as of 3/31, 10.9%, so continuing to increase. Multiple 1.33x, so again, moving in the right direction. If we look at the benchmarks, and again, there's always these questions about what is the appropriate benchmark. We have our benchmark in the IPS, but the one which I'll touch on today is the Russell. So we're underperforming the Russell. Much of that has to do with the strategic repositioning of the portfolio we've been talking about. So once we're able to execute on that plan, will continue to bridge that gap, but I would expect over the next few quarters, you're going to hear the same story from me, which is we're still underperforming the Russell, but that gap will narrow. If we talk a little bit about the portfolios, there's 115 partnerships in the portfolio, representing 77 general partners. The portfolio is 67% buyout, which is in that band of 60 to 80% we've talked about. Venture represents 11%. And just by way of reference for everyone, we've talked about venture. At this juncture, we're not investing in venture going forward. We're looking now to invest in growth capital. The balance of the portfolio is diversified across special situations, which includes mezzanine, distressed secondary funds. Year-over-year return, 18.8%. So while it's a very strong number, again, underperformed the Russell, but more importantly, private equity is a long-term asset class, so we really need to focus more on this 10-year number. Last couple comments would be, one, we've committed to 8 new funds during the fiscal year, committed to 4 new funds in the quarter. Again, going along the lines of what we've touched on before, which is larger commitments to fewer managers. We're pacing 100 to 200 million. We've put at work roughly 150 million, so again, working in the right direction. Last comment I would make, which I think is the most important out of all the comments I made, which is regards to contributions and distributions. If we look at calendar year 2010, contributions exceeded distributions almost 2 to 1. So what that meant is, obviously, we were putting more money in than we were getting back. Q1 of this year, big turnaround. We're roughly going 1.25 to 1, so we're getting more distributions that we're putting in, so the portfolio is, in essence, cash flow positive, which is an important trend. And if you look at the overall market today, if a manager is not selling in this market, they've got a problem. And with that, I would see if anyone has any questions. Thank you.
Any questions on the year in review? No? Right. Okay. So let's go to the monthly review. If there are the agenda today. Okay. We'll do the pension fund and go back to those. Okay, so let's go to the monthly review. We got one. Since we're a little bit behind schedule, I'll be very, very brief on the economy and the slides. Yes, overall, I would tell you we're in a very, very difficult, since the fiscal year ended, so since June 30th, we're in a very difficult investment environment. The investment environment is characterized and overshadowed by the euro, what's going on in Greece, and Italy, and Spain, and Portugal, European monetary authorities' inability or unwillingness to deal with the problem, the impact that that's having on European banks, the U.S. federal government's debate that occurred during the summer on extending or increasing the debt ceiling, the fact that they all agreed to huge deficit cuts and budget cuts over the next 10 years, but ultimately agreed to punt it to November, a special committee. So that's overhanging the U.S. markets, and the U.S. markets looking at Europe, and Europe is sort of overhanging itself. The combination and the additional perception that politics in Washington will keep bouncing the resolution around, perhaps as long as up to and through the presidential election in November, has meant that the markets are in a complete state of semi-panic. The semi-panic is witnessed by the stock market bouncing around and trading a range, and 10-year treasuries crashing through 2%. Today they're at about 1.92%. You may recall the beginning of last year, 10-year treasuries were at 4, so they're at half the rate. So it's penalizing savers in the United States, which is not good. The consumer is watching all this and getting scared, so the consumer's not spending any money. So the consumer's not spending, the government is cutting, and the result of that is the economy has stopped growing at the rate it was growing. It was coming out of a recession. It's slowing down. It's been slowing down for probably the last 4 or 5 months. You add all that together and you get a very complicated investment environment. Our reaction to that has been to harvest cash wherever possible. So if I can get you to page 33. You'll see in the gray, in the circle, in the gray, you have about $600 million in cash, which is 7.3% of the portfolio. The reason for that is we have absolutely no conviction about any of it, but we do have conviction that we'd like to save our money. So we're trying as much as possible to opportunistically de-risk the portfolio. And given the tools that we have, that means cash. As Martin mentioned, in August, we sold government securities, which again is the inverse of the 10-year Treasury at historic lows. Prices are at historic highs, so we're taking some chips off the table. We're doing the same thing wherever possible, so I would expect that number to grow a little bit and then sort of stop. If you turn to the next page, 34, you see that we've, as Martin had mentioned, we're slowly starting to switch and develop a plan to go from the old asset allocation, which is on page 33, to the new asset allocation on page 34. So things are out of whack. That's all right. We've got to get things back into a longer range allocation. That said, this is really, in our opinion, no time to make real investment bets. So that we continue to be in de-risking mode. It's hard to think long term when you have, on any given day, you can have something very dramatic go wrong in Europe, which would take the stock market down a lot. I'm not going to estimate how much, but a lot.
If Greece defaults,
Yeah.
can you predict how we will get back? Directly, indirectly?
We don't do a lot of trading with Greece.
Oh, indirectly, we will.
Indirectly, I would tell you that if Greece defaulted, you would set off a chain reaction that no one can tell you the exact nature. Some of the implications of it would be that the European banks, their stocks would tank. Some of the European banks have their Greek exposure marked at 80 cents on a dollar. Some have it at 50 cents on a dollar. If it defaulted, the answer is it's worth neither of those two numbers is worth less. They'd have a hard time keeping their marks when the reality is down. You might have one of their banks. At one of their banks, you have something that kind of felt like what happened when Lehman Brothers went bankrupt. It would happen in Europe. Everybody would rush into safe securities like U.S. Treasuries. The U.S. markets would see that, our stock market would go down. Our stock market goes down, the crisis of the consumers, and the economy runs to a halt. So not good things happen. So, and you can see little cracks. I mean, the problem with Europe, or the euro, is unlike the United States, we have some guys in Washington kind of have control over the monetary and fiscal policy. In Europe, you have someone in control of monetary policy, but you have 17 countries in control of their own fiscal policy. So it's not a country. So their response, you just can't sit in a meeting like this and say, let's do this. So it's very slow, it's very deliberative, it's not clear what the right answers are. All that combines to create humongous anxiety. So a week ago, I'll tell you exactly how we just came very, very close to the edge of it. So a week ago, there were a couple of banks, I didn't tell you who the banks were, that had a little trouble rolling over their U.S. dollar-denominated commercial paper. And the result of that, they went to the European bank and said, look, we need $500 million. Today, fine, they get $500 million. But what that was the U.S. market saying, we don't want to lend it to you overnight, short term. So the Fed, the ECB, the Bank of England, the Bank of Switzerland, the Bank of Japan all said, okay, buy everything in U.S. dollars. $20. They were worried about the run, a short-term liquidity crisis of major European banks. And they said, we'll do that for 90 days. So we're in this 90-day period where the cavalry has arrived, said we're going to make sure there's liquidity in the system, and that's as far as we go. That doesn't make you feel very good. You're actually very tuned into what they just did. So here we are in this 90-day period. So we're sitting on, stocks and bonds, and we're just trying to figure out what we're supposed to do. And the answer is, well, for God's sakes, do something safe. So again, we're trying to husband cash. We know cash is worth a dollar. But I can't sit here and say, well, look, there's some other slides here which says stocks are pretty cheap. In the long run, they're pretty cheap, but they might get really, really cheap. So I don't think we're going to miss anything in the really, really short term. I'm much more worried that we wake up one day and there's a real problem. As is everybody else, which again, a lot of people are piling into risk-free securities, which are U.S. Treasuries. But the fact that the Treasury market is where it is, it's kind of in a different place than the stock market. The stock market, if you look at one of these charts, it's kind of bouncing around in a very narrow range, kind of waiting for some moves. That's not a good thing. You like to say the nice trend up or some trend down. It's just sitting around, a little bit on the needles, waiting for something to break. And it's just the period where you're supposed to just be very, very cautious. So I would tell you, looking forward, we made 23% last year. It's great. I think it's a very difficult year to make real money because if you roll this out, and the U.S. is going to this budget battle is going on a lot. It's really going to hang around through the election. Because there's no reason for politicians not to have them hang around until the election. That goes through the end of our June fiscal year. That's the U.S. In Europe, you can't just fix it overnight. So you might just wake up and we're just going to muddle through this year. Muddle means we're just not going to make a lot of money. We're going to try not to lose a lot. So I think that's my crystal ball. I don't know, Bob, you might have a different crystal ball, but mine is sort of, let's play safe. Don't need a crystal ball.
I just have longer term worries. When the whole Chinese real estate bubble bursts and we repeat there what we have here and take down the entire world in a few years. Actually,
I look higher at the table.
Do you own a generator, Bob, and do you have guns?
Bob, I wouldn't worry about Bob, $3 trillion in reserves. I don't think I would lose sleep over Chinese real estate. I think my big worry is actually the Greek effect on Japan. And I think in many ways the country that is fiscally worse than Greece is Japan. And I think where the knock-on correlation effects occur is potentially there, and there's just no hedge. You just can't sell it.
I'm sorry,
The last part.
That it's very hard to hedge against that. It's easier to hedge against a small country like Greece. The one other comment I would make is the last experience that we all had and we looked to is Argentina's default. And that was $100 billion compared to about $1 trillion, I think, the Greek debt. So this is orders of magnitude different than anything we've seen. But something that I didn't understand was in Argentina, for example, only the government had hard currency debt. In Greece, every corporation, every individual that has debt has euro debt. So it's not like the government defaults, it's the country defaults. So every bank that has any loan against any company that's based in Greece will then have to accept Greek drachmas. And that's just not possible to imagine or contemplate. The world's never. So it's beyond the $1 trillion in debt. It's in government debt. It's every debt outstanding. So it's just hard to even contemplate a default.
You said that Japan is in worse shape than Greece.
Or second worst shape next to Greece.
Second.
And certainly much worse than the U.S. 200% debt to GDP. So if there is a funding crisis, guess where it heads?
they're also getting hit by natural disasters one after another.
Including political ones, not exactly. It's just been very, very hard. So but the flip side is the hedge to all that is, which is why you've seen treasuries below 2%, is our Swiss franc treasuries. I feel like as a board we need to talk about where cash goes. Because what I don't know is what does Germany come in and do, a euro bond, for example, and they're off to the races from the fear trade, not because we think the economy is going to grow. And so 8% cash, and you give us every indication that it's only going up. Maybe in executive session we can come back and talk about that some more.
Let's do that. Anyway, so that's very upbeat way to say that the first month of the new year was actually okay. If you go to page 36, this is July numbers. July we lost 68 basis points. That was all right. The problem is you flip quickly to page 38, is that August was a very bad month. Seems like a long time ago, but the markets were just the markets had bad days one after another. So that when you look at the numbers in August, and we'll get to the August numbers next month, but generally the stock markets were down 5 to 6 to 7%, 8 or 9 internationally, and spreads widened as people had high yield debt, so the high yield market was down 3 or 4%. In September, it bounced up a little bit, but we're generally behind where August numbers are behind July. The simplest way without giving you guys a projection. The managers are doing what they're supposed to be doing. They're trying as fast as possible because all the markets are going the wrong direction. I guess no manager, it seemed like no manager was no manager ruled. They're just kind of going with the markets. But if the markets are heading down, they're heading down as well. So that's a quick review of the month as well as an overview of the market. So with that, I'm done with our public session in pension fund. And we want to go to the VSS.
So we need a motion to move out of the public section and close this part of the meeting.
Second.
Any objections? Hearing none, the motion carries. We'll start the firefighter durable supplement meeting. I guess I should probably read the roll call.
Give one more.
Ranji Ladaswamy.
Here.
Larry Floss. Larry?
Yes, President.
Here?
Here.
James Slater? Here.
Mind and body.
And Robert Straw?
Yeah.
Okay, we have it. So, I guess, performance reviews, I guess, for...
Do we need any extra copies? Yeah. Everyone have it?
Which one do you do first, Mark?
The firefighters. So if you turn to page 3, you see the fiscal years ending June 30th saw a very strong level of returns driven by the Fed's policy as well as the equity markets. And in fact, the results were over 24% for the firefighters VSF. So yes, congratulations. This is a very strong level of return that we haven't seen on a fiscal year cutoff in quite some time. The longer-term results have also obviously been brought up by our head of the benchmark. So you'll see those numbers, the 7 and 10-year numbers, are now in the 5 to 6-year range, and the 15-year number is 733. So it's come up quite a bit from recent years. The asset allocation is shown on page 4. Bottom part is looks like a lot, but it's really, taking a look at the scale, it's pretty much in balance within the policies. This fund, of course, only invests in public market securities, does not invest in private equity or private real estate. And the equity allocation is shown on page 10. The largest allocation by far is the U.S. equity allocation, which is shown on page 11. And this allocation is half of the entire portfolio as entirely passively managed, and as you would expect for such a mandate, the returns track very closely the results of the benchmark from a risk and return perspective. For the quarter, it was flat for the year over 32%, and as you see, the 10-year number is now a positive number. Non-U.S. equities on page 12 for developed markets, $54 million, 12% of the fund. Here we do have an active management component. Managers did well, returning 33.06, which is nearly 300 basis points ahead of the benchmark. So over the last 3 years, managers have done well here. Emerging markets, we're making the larger fund a 4% allocation, and here returns are strong on an absolute basis, slightly negative for the quarter, but for the year, and a very strong number, just short of 30%. These, we have a single manager here, and happens to be our best performing manager, and so the returns were strong on an absolute basis and a relative basis since the decision was made to enter this asset class over 5 years ago. Fixed income is shown in the summary on page 16, and 2/3 is invested in the core investment grade program, which is shown further on page 17. Underweight treasuries, slightly overweight spread sectors, similar to the larger fund. All positive numbers for the sectors, and each of the sectors, however, slightly underperformed. You see the performance on page 18, down by 25 basis points per quarter, but for the year, up over 100 basis points above the benchmark, returning to 524, and longer-term numbers that are very positive in the 6 to 7% range, with limited volatility compared to equities. TIPS is on page 19. While the manager was behind the benchmark for the year and for the quarter, the returns were strong on an absolute basis, nearly 7% for the year and over 3% for the quarter. Finally, we have high yield, and as we've heard before in previous quarterly reports, high yield has had a very strong run, and the mix of managers we have here very complementary, and the returns are nearly 16% for the year, well ahead the benchmark, and the 10-year number, the 3-year number is over 10%, also well ahead of the benchmark. In short, the fund had a very good fiscal year. Are there any questions?
If there are no questions, I think we need a motion to exit the public session and move into executive session as part of the supplement.
So moved.
Second. Any objections? Hearing none, the motion carries. So we're now into executive session of firefighter supplement.